Fibonacci retracements. It is a tool that displays horizontal lines based on the Fibonacci numbers. These lines can then be used as key support and resistance levels. To use the Fibonacci retracement tool, you first start by identifying a swing low and swing high on a chart. Then, drag the tool from the swing low to the swing high. Next, wait for the price to make a pullback to one of these levels, ideally the 0.382 Fibonacci level, because that's the most common level where price tends to reverse from. So if price touches that level, that could be a good buy entry. Keep in mind that price could also reverse from other Fibonacci levels. Combine it with other confirmation signals to get a better entry. Breakout patterns. It is when price makes a sudden and significant movement towards one direction. This usually forms after the market makes a consolidation period. For example, here we can see that the price is consolidating. Then, it suddenly moves sharply to the downside. This is called a breakout. To take advantage of this, traders could use specific patterns as a guide to identify breakouts before they happen. Most notable breakout patterns includes wedges, triangles, and the rectangle pattern. Reversal patterns. It is when price moves in the opposite direction of the current trend and forms a counter trend. Specific patterns could be identified in a chart which could help traders predict reversals before they happen. Most notable reversal patterns are double top and bottoms, triple top and bottoms, head and shoulders, cups and handles. Elliott wave. It is a theory that suggests that market tends to move in a series of 5 waves before reversing and forming another set of waves in the opposite direction. By understanding the Elliott wave sequence, traders can predict where the price is heading by following the pattern. In a chart, we can label each point of the waves as 1, 2, 3, 4, 5 and ABC. Now, there are specific rules to ensure that a movement is considered as a valid Elliott wave. First, wave 2 cannot be longer than wave 1. And usually pulls back to the 0.618 Fibonacci level. Second, wave 3 must be the longest wave amongst wave 1, 3, and 5. Third, wave 4 must remain above the peak of wave 1 and usually pulls back to the 0.382 Fibonacci level. So here's an example of the Elliott wave in action. In this chart, we can see that the price resembles a possible 1, 2, 3 Elliott wave. And so, based on the theory of wave 4, which is that price tends to pull back to the 0.382 Fibonacci level before continuing upwards, we can use this as a potential buy entry when price makes a pullback. Fair value gaps. A fair value gap occurs when a candle forms a significant gap due to an imbalance of buying or selling. To find a fair value gap, you first need to find a candle with a large body. Then, draw a rectangle at the gap. Place it between the previous candle's wick and the next candle's wick. This level now acts as a potential magnet, where price may revisit before continuing its movement.